Hi, my name is Drew Farrell. I'm the Senior Vice President of Symetra in the Retirement Division, and I'm joined by Dave Kansas. We're fortunate to have Dave as a consulting partner to talk about all things financial services, the sector, behavioral finance, marketplace. Dave is a gifted journalist who has a long career in both being an editor with the Wall Street Journal, TheStreet.com, and he's actually been commissioned by Dow Jones to write a number of different books on financial literacy. Welcome, Dave. I look forward to our discussion.
You bet.
Dave, moving on to the Fed. We hear a lot about the Fed and the administration and the Fed and reactions thereof. But let's talk about the Fed and Wall Street. How do you think that cooperative state is today? Is it different than other administrations, other years? What's the here and now with the Fed and all things Wall Street in your view?
Well, the Trump administration has had kind of an uneven relationship with the Federal Reserve. Um, President Trump, before he became a television star and before he became the president, was a developer. He's a real estate developer, put his name on a lot of buildings. Now, most real estate developers like it when financing is easier than when it is harder.
Easier lending.
They use a lot of borrowed money to build their buildings. So he's always had a tendency to want the Federal Reserve to keep rates lower or to push them lower, and rates have not changed during his administration so far. The Federal Reserve has stated over and over again that they're waiting to see the impact of tariffs on inflation. President Trump has gotten more frustrated by this, and this has upset Wall Street to a degree because they really like the Fed's independence. The independence of the Fed, which sets short-term interest rates, has a job responsible for keeping track of inflation. Wall Street in general wants it to do its job, not with political interference. And there's some feeling that perhaps the White House administration's getting in there more than it ought to. There was a Wall Street Journal opinion story by Ken Griffin, who is the founder of Citadel, a gigantic hedge fund. And he was, quite strongly arguing that the Fed should be left alone. And I would say that represented a fairly broad sentiment on Wall Street in terms of how the Fed should work. So there's a little bit of tension in there right now.
Sure.
And there's also, growing debate on Wall Street, but, maybe rates should come down. There's problems in the housing market right now in certain parts of the country. It's a highly regionalized market. That is directly related to how much it costs to borrow money, which again is where the Fed comes in by setting short-term interest rates. All these different things are happening, and the Fed is just holding the line. And I think expectations are that they will start to become more friendly, ease interest rates. I mean, that is, if you look at the market kind of wagering on interest rates, say over, into 2026, there's a belief that those rates will start to come down. So how that plays out with the kind of back and forth yelling and screaming that accompanies all these discussions, we'll see. But that's kind of what the money being bet is telling us.
Understood. Dave, thanks for the conversation. We appreciate your partnership and you and your contributions.